You're 65. Medicare Part B costs $185 a month. Simple, right? Except last year, you sold some rental property. And now, Medicare just sent you a letter saying you owe $639 per month instead. That's $5,448 more every single year because of something called IRMAA that nobody warned you about. In the next 10 minutes, I'll show you exactly what IRMAA is, how to avoid these surcharges, and what to do if you're already stuck paying them. Here's what's happening. IRMAA stands for Income-Related Monthly Adjustment Amount. It's Medicare's way of saying, if you made good money 2 years ago, you're paying extra for Medicare now. Think of it like airline pricing. Economy passengers pay $300 for a ticket. First-class passengers pay $1,200 for the same flight. Medicare does the same thing. Higher earners pay more for the exact same coverage. Here's where it gets frustrating. Medicare doesn't look at your current income. They look back 2 years. So in 2025, they're checking your 2023 tax return. Had a one-time spike in income that year? Sold a house? Took a big retirement account distribution? Congratulations! You're paying IRMAA surcharges now, even if you're living on way less money today. And these aren't small penalties. We're talking thousands of dollars extra per year. For a couple, you could be paying over $10,000 more than standard Medicare premiums. That's a nice vacation you're giving to the government instead. I know, it's ridiculous that it's this complicated, but understanding IRMAA can literally save you thousands of dollars. So let's break this down. How IRMAA actually works. Standard Medicare Part B costs $185 per month in 2025. That's what most people pay, about $2,220 per year. But if your modified adjusted gross income from 2 years ago crosses certain thresholds, you pay extra. Here's the breakdown. If you're single and made between $106,000 and $133,000 in 2023, your monthly premium jumps from $185 to $259. That's an extra $888 per year. Between $133,000 and $167,000, you're paying $370 per month, an extra $2,220 per year. Hit $500,000 or more, your monthly bill is $628. That's $5,316 extra every single year. And here's the kicker. These brackets apply to Part D prescription drug coverage too. You pay additional surcharges there as well. Married couples filing jointly have different thresholds. The surcharges start at $212,000 of combined income. At the top bracket, over $750,000, you're each paying that maximum surcharge. Now here's what trips people up. This isn't about your current income. You could be fully retired right now, living on $50,000 a year. But if you had a high-income year in 2023, maybe you sold a business, cashed out investments, or took a large IRA distribution, you're paying IRMAA surcharges in 2025. One woman I know took a $200,000 distribution from her 401k to pay off her mortgage in 2023. Smart financial move, right? Except now she's paying an extra $4,800 in IRMAA surcharges this year. Nobody warned her that distribution would trigger Medicare penalties 2 years later. Still with me? Good. Because this next part shows you how to avoid these surcharges in the first place. Planning around IRMAA before Medicare. If you're not on Medicare yet, you've got time to plan. Here's your strategy. Let's say you're 62 right now. You're planning to start Medicare at 65, which means you need to watch your income starting at age 63. Whatever you earn at 63 shows up on your Medicare bill at 65. This is when you do your big financial moves before that 2-year look-back window. Need to do a Roth conversion? Do it before age 63. Want to sell investment property? Do it now. Taking a large retirement account distribution? Get it done before you hit that look-back period. Here's a real example. Tom is 62. He's got $400,000 in a traditional IRA that he wants to convert to a Roth over time. If he waits until he's on Medicare and converts $100,000 per year, he's triggering IRMAA surcharges every single time. Instead, Tom converts $100,000 at age 62 and another $100,000 at 63. Yes, he pays income taxes on those conversions. But by age 65, when Medicare starts, those conversions are in the past. No IRMAA surcharges. He just saved himself thousands in Medicare premiums for years to come. The same strategy applies to selling real estate, taking business buyout payments, or cashing in large investments. If you can time these income events before Medicare or bunch them strategically, you avoid the surcharges. Now, what if you can't avoid a high-income year? You're 64, you inherit money, or you have to sell property for family reasons. Here's where timing matters. Let's say you're turning 65 in June 2025. Medicare uses your 2023 income for Part B premiums. But if you have a spike in 2024 income, that won't hit until 2026. You got 1 year of standard premiums before the surcharge kicks in. If you're already on Medicare and can't avoid a high-income year, try to bunch income together. Instead of taking $80,000 from your IRA each year for 5 years, consider taking $200,000 in 1 year. Yes, you'll pay IRMAA surcharges that 1 year, but you'll have standard premiums the other 4 years. The math often works out better. Here's another thing most people don't know. Municipal bond interest doesn't count toward IRMAA income, but taxable bond interest does. Qualified dividends count at their full value, even though they're taxed at lower rates. These details matter when you're close to an IRMAA threshold. If you're making $105,000 and thinking about taking $10,000 from your IRA, don't do it. You'll cross into the first IRMAA bracket. Wait until next year, or take $5,000 this year and $5,000 next year. Stay under that $106,000 threshold. Getting out of IRMAA, the appeal process. Now, here's where it gets interesting. You can appeal IRMAA surcharges, but only for specific life-changing events. Social Security has a formal appeal process. If you experience certain life changes, you can request they use a more recent year's income instead of the 2-year look-back. Here are the events that qualify: marriage, divorce or annulment, death of your spouse, you stop working or reduce your work hours, you lost income-producing property due to disaster or other circumstances beyond your control, you experience a loss of pension income. Notice what's not on that list: regular retirement. I retired and my income went down. Doesn't qualify unless you lost pension income. But here's the key. If you had one of these events and your income dropped significantly, you can file Form SSA 44. This tells Social Security to use your current year income or last year's income instead of the 2-year look-back. Real example: Susan's husband died in January 2024. Their combined income in 2023 was $220,000. Now Susan's income is $60,000, just her pension and Social Security. Without an appeal, she's paying IRMAA surcharges based on that old joint income. With Form SSA 44 and proof of her current income, she gets standard Medicare premiums instead. That's over $4,000 back in her pocket every year. The same thing works if you stop working. Let's say you're 66, still working, making $150,000. You retire in March 2025. Your 2023 income triggers IRMAA surcharges, but you file Form SSA 44 showing you stopped working and your 2025 income is only $40,000. Social Security recalculates using your current income. Surcharges disappear. You can file Form SSA 44 online through your Medicare account or take it to your local Social Security office. You'll need documentation: tax returns showing your new income level, death certificates, divorce decrees, whatever proves your situation changed. One warning, this appeal process takes time. Sometimes 30 days, sometimes 60. You might pay the higher premiums for a few months before they adjust it and refund the difference. But it's absolutely worth filing. 3 expensive IRMA mistakes. Mistake number 1, taking a huge IRA distribution a year before Medicare starts. I see this constantly. People turn 64, decide to take out $150,000 to pay off their house, and then they're shocked when Medicare premiums are sky high at 65. That distribution in your 64th year, you're paying IRMA surcharges from age 66 through at least 67. Could cost you $5,000 or more over those 2 years. How to avoid it? Take large distributions before age 63, or spread them over multiple years after Medicare starts to minimize surcharges. Mistake number 2, not appealing when you absolutely should. Your spouse dies, your income drops by 60%, and you just keep paying the high IRMA premiums because you don't know you can appeal. That's leaving thousands on the table. How to avoid it? File Form SSA 44 within 12 months of the life-changing event. Don't assume Medicare will figure it out. They won't. Mistake number 3, forgetting about your spouse's IRMA. You're both on Medicare. You take a $100,000 distribution. Now you're both paying IRMA surcharges, double the cost. One income event, 2 IRMA bills. How to avoid it? Calculate the total Medicare cost for both of you before making big financial moves. That distribution might trigger $8,000 in combined surcharges. Here's what you do next. First, if you're not on Medicare yet, pull out your calendar. Count back 2 years from when you turned 65. Mark that age. From that point forward, every dollar of income affects your Medicare premiums. Plan your big financial moves before that date. Second, if you're already on Medicare and paying IRMA surcharges, check if you qualify for an appeal. Did you experience a life-changing event? Did your income drop? Get Form SSA 44 from the Social Security website and file it with proof of your new income. Do this within 12 months of the life-changing event. Third, log into your Medicare.gov account and check your current premium. Compare it to the standard $185 per month. If you're paying more, you're in an IRMA bracket. Pull your tax return from 2 years ago and see which bracket you're in. Fourth, if you're planning to take money from retirement accounts, sell property, or have any major income event, run the IRMA numbers first. Use the income brackets I showed you earlier. Is crossing that threshold worth the extra Medicare costs? Sometimes yes, sometimes no, but at least you'll know what's coming. Fifth, set a reminder every year to review your IRMA status. Your income changes, the brackets adjust slightly for inflation, and you want to stay on top of this. 10 minutes of planning can save you thousands. Bottom line, IRMA surcharges can cost you $7,000 or more every single year if you're not careful. But now you know how they work, how to plan around them, and how to appeal if you need to. The key is thinking 2 years ahead. What you do today shows up on your Medicare bill in 2 years. If you're dealing with IRMA right now or trying to plan around it, drop a comment below. I read every single one. Next up, I'm breaking down the 5 biggest Medicare enrollment mistakes that cost people thousands. You don't want to miss it. In order not to miss, kindly hit that subscribe button. I'll see you there.